Joining us now is BTIG's Jonathan Krinsky. Jonathan, obviously a bit contrarian. We have yields going up, the very well understood challenges to commercial real estate down the road. What are you seeing technically that gives you a sense that maybe there's a trend change here?
Yeah, so as you mentioned, Mike, worst performing sector, not only over the last 12, but the last 18 months. So just, pretty poor performance there. Sentiment probably equally as poor in the space. And I think it's important to remember, first of all, how much sentiment can matter. So if you go back 6 months ago, where was sentiment on the tech sector? It was pretty negative, right? So I think sentiment's the first backdrop, but the second backdrop is the slowly but surely turning of the trend, and we're starting to break that 18-month downtrend in the REIT index. You're getting back above all the moving averages. The 200-day is starting to flatten out. So I think from a trend perspective, things are improving a bit. Sentiment is certainly there. And then some of the names also have, extremely high short interest, in some cases 20, 30% of the float. So, it doesn't take much to turn those names when you get any little bit of positive news. And then the last point is, you mentioned, I think the problems in commercial real estate are well known, but parts of the REIT market, like apartments, for instance, are actually doing well today. I think with the new high of mortgage rates, maybe that's pushing people again into the rental market. So a name like Avalon Bay is actually up 1% today.
Mm-hmm. Yeah, good point. It's obviously not a monolithic sector. Is this a market in general where you feel as if it pays to look for a chance to play laggards, to kind of look for catch-up opportunities, given that it's been such a bifurcated market, or is this an isolated opportunity?
I think to some extent, our call into the third quarter has been looking for a bit of mean reversion. I think, we're expecting and continue to expect some downside reversion, in some of the growthier names, parts of the market. I think it's been well documented that the NASDAQ has not had a down July since 2007. And we're actually fading that seasonality in the NASDAQ. I think, that's a part of the market that, people are pretty much fully all aboard with. So, I think there's bits and parts that you can fade on the edges, but, I don't think you want to be, dumpster diving across the board. But I think REITs are an opportunity where, sentiment's washed out, positioning's washed out, and they do have a bit of a defensive characteristic in times. I know there's the interest rate part of it, but, they also can act as a defensive sector. So we kind of like that here.
Sure. More specifically on today's action, it was pretty comprehensive downside flush in the morning. It's kind of gotten some traction along the way. What's your read on how the markets behaved today, how it fits into the general field position?
Yeah, I mean, we've last time I checked, we were about 90% downside volume on the NYC. If that holds, I think it would be the first 90% downside day since March. So, definitely a day to take note. They did bounce them off the morning lows, which, we continue to see that dip buying mentality. It does take a little while to break that, I would say. Obviously, interest rates are a factor with, the psychological levels you mentioned. The 2-year above 5%, the 10-year above 4%. So, things do feel a little bit different, but again, to break the the buy the dip mentality, it'll probably take a little bit more than just this one-day shock. But ultimately, we do think S&P at least needs to pull back to that 4,200 breakout level. And that really to get there, you're going to need to see mega cap tech succumb, which we just talked about.
Right, for sure. Yeah, so it's certainly a few percent down from here. I know you've been working on this thought that this year is stacking up as being almost the inverse to 2022 in terms of market cadence, some of the seasonal stuff, I guess even investor expectations. Where does that place us right now? I know you're not basically saying it's a blueprint for the rest of the year, but where does it place us right here at the beginning of July?
Yeah, it has been uncanny. Again, you go back to the beginning of this year, and the consensus seemed to be for a bit of a weak first half of the year and then a rally in the back half. Of course, the first half was kind of the opposite. And if you look, it has been almost an inverse of last year, where last year was weak right until June. Then you had that kind of waterfall move after the CPI report in June, kind of culminated with a bottom just after the mid-month FOMC last June. You rallied a bit. you chopped around a bit, and then you took off in July after the 4th of July. This year, what do we have? We had almost the opposite, where you had a nice rally into June. You had an acceleration into the FOMC, kind of topped out. You've been chopping around, and then we've seen a bit of weakness post the 4th of July. So again, we don't expect this to continue to track so closely, but I think it does speak to where sentiment was, what the consensus was for the market on January 1st of this year and where it is right now. And I think expectations, positioning have all come a long way in the last 6 months. And, that again goes back to our thought to fade the NASDAQ seasonal strength that a lot of people continue to think will happen this year.
Yeah, good point. Good reminder that a lot of what's going on this year is really just taking back some of those deep losses in the growthier parts of the market in 2022. Jonathan, great to catch up with you. Thanks so much.